Studios, the AusBiz COB is the key stuff you need to know about the day in business and finance.
Monday afternoon. Nice to be here with you. I'm Nadine Blaney, and this is the COB, whether you are watching us live, on demand, or listening to us in podcast form. I hope you had a good session out there. It was a bit more positive than we've seen lately, with the market looking like we'll finish well into positive territory. Here is the SIBO index. I'll just bring that up for those of you listening. You can't see it, but it's up by about 0.5%. The S&P ASX 200 is sitting at 8,691. We watched U.S. futures come online today, and they were quite hot, and they continue to be so, with the NASDAQ futures up by 1.4%. E-minis for the S&P 500 up by close to a percentage point as well. All of that is happening off the back of some more positive headlines coming through from the United States in particular when it comes to negotiations around the Iranian war and opening of the Strait of Hormuz. That being said, it hasn't happened yet, and I think that's why it's led to one of our key themes of the day being the art of the slow deal. I mean, those cynics that I spoke to today say, we've heard this all before. There's going to be some sort of a peace proposal. And of course, nothing has been forthcoming just yet. But I will say that we've heard from Marco Rubio in the United States. So he is the Secretary of State there, of course. And he said that the U.S. will find, quote, another way if the talks fail with Iran. But it's safe to say that we have seen a lot of positivity around the Asian region today. Just take Tokyo's market. Its stocks have hit a record high today. Oil has really eased. I mean, let's call it what it is. Oil has tanked today. See how we did that? Off by about 5%. The dollar, the US dollar, has also eased. You know, it's one sector that has done extraordinarily well. That is the coal miners. So we'll get to some of these sectors to fill you in a little bit of a pulse check as to what's been happening today out there. Now, the banks have not really come to the party at all, but we are looking at some key sectors being the energy space, again, proving to be a pretty big weight on this market overall. We've also seen a real positive momentum coming through from the gold miners. So 6 out of the 11 sectors are higher today, heading into the close. Materials is the best performing sector thanks to those gold names. Energy is the worst. Healthcare also coming under a little bit of pressure as well. Let's get across some of these corporate stories. And Coronado Global Resources is selling a mining complex in West Virginia as it moves to cut costs and shed future liabilities. Beach Energy, meanwhile, is selling a 60% stake in a permit in the Otway Basin. Amplitude on the other side of that, doing well. Fortescue Metals saying that former Chief Executive Elizabeth Gaines has resigned as an executive director. That was our stock of the day. Charter Hall has risen on an earnings forecast hike. And Guzman & Gomez continued rising, although it did trim some of its earlier gains. Morningstar saying, Australia, Japan, Singapore in focus, obviously, in the wake of its pulling out of the U.S. But I did read that there's some sort of court action being taken against Guzman & Gomez. I don't know all the details, so I'm not going to mislead you in that way. But it's just one that bears watching because, of course, they were so committed to that U.S. strategy. Even back in the last reporting season, I spoke with Stephen Marks, the CEO, and he was in Chicago, and he was talking it up and telling us that, they were going to push ahead, but pulled up stumps regardless. Let's move away, though, from corporate news and get to the bigger picture. And for that, I'm really pleased to welcome David Scutt from StoneX. Scotty, what is helping these markets? Like, what's propelling these markets higher, do you think? Is it really just headlines coming from Donald Trump and team?
G'day, mate. Great to be back. Yes, it is a bit of a perpetual cycle that we're seeing. Start of the week, we get some very positive news in the US on Sunday, and then we go off to the races. And it's just been this constant mechanism. And the one thing that's really stuck with me is that when you look at how all these markets have performed over the course of the past couple of months, very quick to go and latch onto good news but very, very tardy when it comes to reacting to anything that's negative. Now, we know the path of least resistance at the moment when it comes to these negotiations is towards a peace deal of some sort. There is no appetite to go and escalate. But the markets now have priced this in entirely, in my opinion, and then some, which will create some really interesting trades, in my opinion, when we actually go and get resolution and an end to this war.
So what kind of trades are you thinking will be really interesting?
Well, at the moment, we're just thinking about great, war's over, time to go and party, off to the races. And I can understand some asset classes that are in that boat, but there has not been enough attention paid to the second round inflationary effects that we're going to see in the economy that are going to go and linger for not only quarters, but probably years. And that is going to have ramifications for growth, real growth, and earnings. And at this point in time, I see there's a lot of sectors that have performed very strongly in the tech space, and I can see there's some very strong catalysts and fundamental catalysts behind that. But some of those other parts of the market, I'm just not convinced are. The more cyclical areas have not really gone and priced that in my opinion. I think they're still looking at a far too rosy outlook depending on what happens with this war.
So are you talking about cyclicals as in equities? Traditionally, we would think, more commodities are more cyclical. Obviously, we've got consumer stocks, particularly under pressure. Or is there some other sort of expression of that we can keep our eyes on?
When it comes to actual how you go and play it, for me, it's still about, from an equity standpoint, it's still those areas that are really tied to the real economy that I'm focused on. Commodity space obviously is very cyclical in nature. We know energy is very attuned to what's going on, but I'm a little bit less reticent to go and say that commodities are going to be in a world of hurt depending on what happens here. I think there's still going to be an environment where it'll be fairly nice. So from an international perspective, cyclicals look okay when you have the commodity side of it. Domestic equities, those tied to the household, those tied to the consumer, businesses, capex outside of the tech space, I think are going to be real laggards in the period ahead.
All right. Can you just get us up to date as to what's happening when it comes to yields? Because this time last week, we were very concerned about some of the moves that were happening in the bond market. Seems to have calmed down a bit, but how on edge are bond markets still?
Look, yields have come back a little bit, but not a lot. We still have US 30-year yields trading above 5%. And what you're looking at here is this is real yield. So this basically goes and adjusts for the expected inflation outlook. You've got in grey 5 years and in black is for 10 years. So benchmark 10-year real yields. And last week, they went and approached 2.2%. So very elevated, particularly in more modern times. And usually creates pretty big headwinds for risk assets. And then lo and behold, at that period of time, it may have just been a coincidence, but you start to see global equities really wobbling. And that's not unusual because if you look at this next chart here, this is basically Vanguard's all-world ETF. And what I've done is I've gone and used the red shading to go and indicate when benchmark 10-year US yields were sitting around 2.2% in the past. And you can see the overall trend has clearly been higher, but when it's got to these particular levels, it's a pain point for risk assets. So to me, that's one to go and keep a line in the sand when it comes to risk appetite at the moment. If for whatever reason we see that long bond yields start to go back up again, and I suspect that they will in the not too distant future, this is something to go and keep in mind no matter what you trade at the moment. Risk assets will not like an environment where real yields are very, very elevated.
But look, we seem to have pulled back from the brink as we've said. So when you think about the stance of the new Fed chair, when you think about what could happen in terms of interest rates in the United States, like what are you anticipating now? How well aligned do you think the market is? And does that also introduce sort of an element of risk?
It does, although when you go and look at what's being priced in, whether you're talking about swaps markets or you're talking about the Fed funds curve and with the shape that you've got there, markets have already got a full hike priced in from the Fed by the middle of next year. And this year, we still have around about 15 or so basis points of tightening priced in. So that's interesting in itself. I found Governor Waller's comments last Friday really, really interesting as well. He was like a staunch dove for a long period of time. And the fact that he said it's crazy now to be talking about cutting rates, obviously he didn't know the news over the weekend. But I think Waller is acknowledging by what he said that these second round inflationary effects are going to be in place now, and you can't go and dismiss them. And the fact that he said it, I suspect we'll start to see some other Fed members come out now and at least ditch the easing bias. Now, at the margin, that's going to create some headwinds there when it comes to more cyclical parts of the US market and maybe some other parts of the global equity universe. But when you look at the overall trend and look at the size of the components that are driving this rally, it's tech and they don't care.
Yeah, it's incredible. Really interesting times. But we have been told for so long that the Fed was data dependent. We're being told now it's not going to be as data dependent under war. Sure, has anything sort of changed that sort of fundamental assumption, I suppose?
Mate, I actually feel a lot more comfortable with Fed independence than what I would have done, say, maybe 12 months ago. And it's been really reinforced by some of those Trump appointees who are governors and those who are aligned with the Republican Party. And they've really filled me with a sense of confidence that they will go and act if it's required. Now, the counter argument, of course, is that you could go and look where inflation is in the United States right now and how far above target it's been pretty much since the period immediately after the pandemic, and they haven't gone and done what their mandate is. But when it comes to will they go and run it hot? Will they purposely go and cut rates when the outlook doesn't really need it? I'll be very, very doubtful on that. Yes, Walsh might want to go and talk about productivity gains and the disinflationary effect that may have. But right now, that's got to be proof in the pudding. And we haven't seen that. And what we're seeing instead is that this AI rollout is creating inflationary forces, and it's helping to go and drive up borrowing costs at the same time.
Yeah, really interesting. And so when we are thinking about oil and we see, such a significant price decline today, what we're saying and what a lot of analysts have told us on the channel today is that it's still, don't be confused. You see light crude down by close to 6%, Brent off by 5.5%. The inflationary impacts, the reopening, the infrastructure rebuild will take long enough that the inflationary pressures will continue.
Undoubtedly, unless we have a major global downturn, and you can't go and rule that out. But at this point in time, if growth manages to go and hold firm, inflation is in the system one way or another. And anyone who tells you anything else than that needs to go and look at what's going on in the real world now. Like I'm seeing anecdotally real evidence now where you see the transfer of these high energy prices into other products, other services. It's undeniable. And I suspect that that's going to start to go and show up in the data increasingly. So I completely agree with what they've been saying on the program.
Well, hope springs eternal. We've got Eurozone yields dropping across the board, optimism growing for that Middle East peace deal. Here's hoping. Does it complicate factors that we've got a public holiday in the US as well?
A little bit. It's nothing unusual to go and have very thin volumes on a Monday in Asia. We've had to go and deal with it for decades, of course, but it is a little bit of a question mark. And we know how headline-driven this market can be. All it will take is a headline that comes out from the Iranian side of the equation, really casting doubt as to whether there is progress on this deal, and a lot of it could go and unravel. So it looks nice on paper. I wish I could go and have a lot more faith on it. Overall, I think that the war will end at some point in the near term, but there's still, unfortunately, a lot of headline risk between now and then.
All right, we'll leave it there then, Scotty. Thank you for joining us. Have a good Monday evening.
You too. Take care.
All right, our stock of the day, as I mentioned, was Fortescue. We did a bit of a blue chip special on the call today. Raymond Chan from Morgans, David Lane from Ord Minnett.
I have a whole recommendation. We are a little bit more cautious, partly because what you suggested. So today's announcement is just another example of staff turnover that we are seeing with Fortescue business in recent times. So that certainly get us less bullish about the situation. And of course, Fortescue need to spend a lot of capex on the non-profit generating area, like the green energy audit. So that will certainly drain on the cash flow.
Although Elizabeth Gaines has been involved with the company for a long time and is very well respected, I think it's an interesting appointment that Sigrid Kaag has a lot of international experience, as you mentioned, as a finance minister and actually Deputy Prime Minister of the Netherlands for a while as well. So certainly there's a lot of political influence and the global nature of the business. So, yeah, I think that's a positive. But I guess similar to Raymond, that accumulate recommendation really means buy on weakness.
10 stocks picked by you, 2 experts, 1 hour.
Let's get to the companies that have been nominated by you.
It's like a witch hunt over there. Everyone hates data centers.
Just remember that most of their earnings are offshore, so there's no franking credits.
The call is brought to you by Centuria, an ASX-listed property fund manager with $21 billion in assets under management. Want to diversify beyond equities? Explore the Centuria Sydney CBD Prime Office Fund at centuria.com.au.
Okay, so let's get back to it. Let's check in on the companies that led this market higher by percentage change. So you can see, in keeping with one of our key themes of the day, we saw the gold miners, we saw the coal miners looking really strong today. Resolute up by close to 11%. And then you get Hyperion X in there, which I would say has something to do with the whole war footing that we're on, although I don't see any specific news associated with that lift. On the flip side, we've got Seek. Seek is down by close to 5.4%, $12.10 per share. Again, I can't see any news, but you know why Karoon Energy fell. The energy complex was hit very hard as we saw oil prices drop pretty close to 6%. Viva Energy, look, high valuations, 4D Medical off by 4%. And Woodside Energy, again, a reflection of, hopefully some progress in terms of peace talks in the Middle East. Small to mid-cap space, again, we've got coal dominating Coronado. We detailed the news earlier, up by 21% at asset sale to 27 cents per share. Mika Metals, well, this is a coincidence. We were talking with Brian Chu from the Australian Gold Fund earlier, and he listed Mika Metals as one in the smaller end, very small end of the market that had some potential. It's up by close to 16% to 13 cents per share. Now, on the other side of the equation, we've got Worker off by 10.3% to 9 cents per share, and E-Road down by 9% to 73 cents per share. Well, we've got, as I mentioned, U.S. public holiday. It's Memorial Day. It's the official start to summer. Also, public holidays in the UK, France, and Germany. Oh, to have a public holiday. Tomorrow, here, we get the Bank of Japan core inflation read. So that'll be an interesting one to keep an eye on. And we also have some updates coming on the corporate front, Champion Iron and Infitril amongst those. So what happened here today? When all was said and done, we have seen the S&P ASX 200 put on, about 0.4% to 8,692. Markets around the region in positive territory. U.S. futures looking very strong. Energy dropping, absolutely tanking, down by about 5.5%. We have plenty of analysis on the energy price up online, ausbiz.com.au. If you usually listen to us in podcast form, we've got amazing interviews that we've done on all of the aforementioned topics, talking points throughout the session today. So do yourself a favor, go online and catch up with what you may have missed. And we look forward to seeing you once again tomorrow.